Hey guys, I'm so excited. Today we're going to do the statement of comprehensive income. Okay, this is a question that we are going to address right here. I'm so excited. It's you're going to learn a lot today. I can promise you that. Okay, so let's start here. It says that the following information is taken from the account records of B&B Travel, a partnership with Bok and Bafana as partners at 29 Feb. This is very important. 29 Feb 2012. The financial year of the partnership. So what they've given us is it's a trial balance, as you can see there. Okay, list of balances, and then what they have also given us is this is where it ends. Additional information, year-end adjustments, and then also the required. Okay, so what's required? Okay, with regard to B&B Travel, the first thing we will do 2.1, and then the next video we will do 2.2. Okay, so we have to calculate the comprehensive income of the year ended for 12 months. Okay, now this is easy, guys. You will see this is very easy. Okay, with regards to our three-step formula, okay, we always start with the calculations or the workings. Okay, that's the most difficult part. Okay, if you can master doing calculations and workings, everything is easy because it's a three-step formula. First thing, you do the calculations and the workings. Second of all, you memorize the layouts, and third of all, you just plug the values into the layouts. It cannot be easy more. It cannot be more easier than that. Okay, we are going to do that. You see the workings are a little bit tricky, but once you over that hump, you're not gonna have any more problems. Okay. So now the first thing we learn here is number one. Let's do number one now. Let me get that bigger. Okay. With regards to number one, it's each partner is entitled an annual salary of 60,000. So I'll say that to the current accounts, right? So that's what it means. It means you must add that 60,000 to the current accounts. Okay, you'll see later on that will become very important. Okay, then the second thing is interest per annum. Okay, so number two is interest of 5% per annum is to be allowed on the opening balances of partners' capital and current accounts. Okay, so we will first start with the capital accounts, right? So now let's go to our trial balance. Okay, on our trial balance, we can see that Bok, on his capital account, he has 200,000, right? He added 200,000. So I will say capital account. Okay, capital account Bok. Okay, we know that he has 200,000. So we times that by 5%, right? So 5%, we know that it's 5 divided by 100. That gives us 0.05, right? Close that up. Right. So that equals to, let me get my calculator. So it will be 200,000, right, times 0.05. That gives me 10,000. Okay. That gives me 10,000. Okay. So it's very easy, right? So the other thing I just want to point out, guys, before we go too far, okay, is you must, every time you do your workings, what must you do? You must reference it. Okay, I want to show you the correct way to do it so that you know how to properly reference your work. Okay. Okay. The way you do it, you should do it correctly, because what's important, guys, it's your examiners, they don't care if your answers are right or wrong. They just want to know how you arrived to your answers. Okay, so now this will be my number one. Okay, I hope you can see my beautiful handwriting. Okay, that's my number one. Okay, let's move on. Then the second thing is the second capital account for the other partner. Capital account, we know is Bafana. Okay, we know that is Bafana. Okay. Now let's check how much Bafana has. He has 300,000. Right. So Bafana has 300,000 times 5%. That will be 5 divided by 100, right? Which will equals to 0.05. Okay, let's calculate that. Okay, so it will be 300,000 times 300,000 times 0.05. That gives me 15,000. Right? 15,000. Okay. Please reference your work. So what will happen? I will call that number 2. Right? So the examiner knows where did I get the 15,000 from. That's the most important thing, guys. Okay, I cannot overemphasize on that because it is very important. Even if your answer is wrong, you will get marks because they would see that you've done it correctly. Okay, now we go to current accounts. Account of Bok. Okay, let's see how much Bok has. It's what's important. It's a debit account. That means it's a negative account. Okay, it's 15,000 times. Now I'm sure you know by now how to calculate a percentage. I don't have to do the long illustration. So it will be 15,000 times 0.5. It gives me minus 750, right? So you know it's a negative balance. Okay. Okay, that did not work out so well. Let me fix that. Oh yeah, what did I do now? Okay, it's the current account, Bok. Right. So we know that Bok, it was 15,000 times 5%. That gives us 750, right? Give us 750. Okay. And the second current account is current account Bafana. Let's check. It's a positive balance. It's a credit balance. That means it's a positive balance. It is 9,000. Okay, so that will be 9,000 times 5% equals 2. Okay, so let me calculate that. It's 15,000 times 9,000 times 5%. It gives me 450. Right. So let me reference that work. This will be number 3. Right. And then this will be number 4. Okay, nice. Okay, let's move on. Now we come into the year-end adjustments. Okay, number 1. The long-term loan Bafana acquired. So the most important thing, guys, you need to know your dates. Okay, when was it? It was on the 1st of Jan. Okay, the long-term loan from Bafana. Okay, let's get that right. It's very important we get that right. The long-term loan from Bafana. That means Bafana gave the partnership the loan. You get it? So Bafana was acting not as a partner, but now he was acting as a creditor to the partnership. So Bafana gave the partnership a loan on the 1st of June 2012, and it was at a 12% interest per annum, which was to be paid on the 30th of June. Okay, so what's important here is it's the date, always the dates. Okay, so now let's get the dates right. You always start there. Okay, so we know that it's a 1 of Jan 2012, and then 2, our year of interest is the 29 of Feb, right? 2012. So it's 29 Feb. Okay, 2012. That means it's how many months? Okay, it's 1st Jan. Okay, then Feb. That's 2 months. Okay, so it is 2 months. Makes sense? So it's the 1st of Jan and the 1st of Feb. That's 2 months. Okay, so please ensure that you you understand that. So it's 2 months. Now our calculations will be as follows. Will be so how much of the loan was it? Let's go to the trial balance and see how much of the loan was it. So loan from Bafana, there's it was 50,000, right? So it was 50,000. 50,000 times it was 12% times 2 months, 2 over 12, right? So that's how much. Let me get my calculator. So it's 50,000 times 12% times 2 over 12. That gives me 1,000. Okay, so I hope you understand how I get that, but practice it. You know, it's easy once you start doing those practices in. So that's workings number 5. Okay, done. Now we go to number 2 now. Okay, going to number 2 now. So during the year, Bafana received 12,000 on entertainment allowance, right? Entertainment allowance was correctly debited to his drawings. Okay, so now what's important is that any transaction handled by the partners is taken care of in the current accounts. Okay, so when you do the drawings, it will be handled in the current account. So he was given 12%, which was subtracted from his drawings as part of his current accounts. But Bafana used the allowance to buy private suit tickets. Okay, now what Bafana did, he used the money to buy tickets to a soccer match at Orlando Stadium at a cost of 2,000 per ticket, right? All tickets were awarded to clients of BNB Travel. So that means Bafana did not use the money, you know, for himself, because all the money that the partners use for themselves, you know, we account for that in the current accounts. But now, since it was, you know, it was drawn from the current accounts, but now Bafana used it on the clients of the partnership. So that means Bafana did not use that money for himself. It was used for the benefit of the partnership. So we need to correct that. So that means that money that he used to pay for the tickets needs to be an expense from the partnership, not an expense from Bafana. Okay, because when it's an expense from Bafana, it will be drawings, which will be taken away, which will be an expense on his own current account. Okay, so that means you need to correct that. You need to say the amount that Bafana used to pay for the tickets, which was the clients of BNB, must be paid by the partnerships, not by Bafana. Okay, I hope that makes sense. So now we know that Bafana paid 2,000 per tickets for how many clients? It says that for 4 clients, right? 4 clients. So that means we need to take that 8,000 and it's an expense on the partnership, not an expense on Bafana. Okay, so we can say entertainment expense. Okay, entertainment expense. That's an expense on the partnership, not on Bafana. Okay, so that means we will subtract this 8,000 from the partnership. Okay, which that's how you pay for that expense. Bafana won't have to pay it from his own current accounts. Okay, that's what it means. So let's do that. This is number 6. Okay, that's number 6. Okay, let's move on. Now we're doing number 3. Due to cultural. Okay, let me just do this to ensure that I'm done with it. Okay, we're done here. We are done here. We are done. We do number 3 now. Due to cultural differences, okay, that's the reason why the partnership nearly split. That nearly split the partnership into 2 factions. The partners decided to go for a cultural diversity program. Each partner received 10,000 from the partnership to pay for the program. These amounts were incorrectly included in the salaries paid for to the partnership during the year. So same problem as before, is that this money was an expense to their current accounts. That means the individual partners, they had to pay, which it was incorrectly accounted for. The right way to do it is it was an expense against the partnership. Okay, so we need to take 2 times 10,000. Okay, which will give us 20,000, and we need to debit that amount. We need to this needs to be an expense to the partnership, not to the individual partners and their own in their own current accounts. Okay, so now we'll call it training expense. You can call it anything you want, it does not matter, as long as it's not subtracted from the partnerships, from the current accounts. It's debited correctly to the partnership, not to the individual partners. Okay, so that's an expense to the partnership, not an expense to the individual partners. Okay, wonderful. Number 3 is done. Now let's do number 4. Okay, provisions must still be made for depreciation on vehicles at 25% according to the diminishing balance. Okay, let's go to number 5, because we cannot do number 4, because then you will see why. Number 5, the accountant of the partnership inevitably forgot to record the sale of the vehicle costing 60,000. Okay, the vehicle was sold for 30,000 on 1st December. That's very important. Know your dates. 2011. On March 2011, the vehicle had an accumulated depreciation of 24,000. Okay, so now let's do that. As long as you know your dates, you're not going to have problems, believe me. Okay, now the first thing is we need to get the depreciation for the current year. Okay, that's the first thing we need to do, because we know that from the time the vehicle was bought to the time to the 1st of March, it was 24,000, right? But we don't know from the 1st of March 2011 to the 1st of December how much was the depreciation. We need to calculate that. Okay, from the beginning of the financial year to the time that the vehicle was sold. We don't know the depreciation there. Okay, so I need to calculate the depreciation. So I need to know it's how many months. It's 1st of April. It's April, May, June, July, August, September, October, November, December. That gives me 9 months. Okay, very important. 9 months, right? So now we know that the vehicle was bought for 60,000, right? Minus the depreciation before the 1st of March, which was 24,000. Okay, so how much is that? Let me get my calculator. So it's 60,000 minus 24,000. That gives me 36,000. Then you times it by how many months? 9 by 12, right? And then what's our it's 25% per annum. 25%. Okay, now let's get that. How much is that? You get it's 36,000 times 9 over 12. Okay, times 25%. That gives me 6,750. Okay, so that's how much I get. That's how much for the year that from the 1st of March to the 1st of December. That's how much depreciation was on the vehicle that was sold. Okay, now we need to get whether we made a profit or a loss when we sold the vehicle. Okay, so how do we do that? We know that we bought the vehicle for 60,000, right? And then we know that the depreciation was how much? It was 24,000 plus 6,750, right? At the lifetime of the vehicle. That's how much the depreciation amounted to. 24,000 was before the 1st of March, and after the 1st of March to the time that it was sold, it was 6,750. So we need to calculate that. So it will be 60,000. Okay, let me make it easy, so if there's a mistake, an examiner can pick it up. So 60,000 minus, so there it gives me 17,250. Okay, so 60,000 minus 17,250. I get, okay, that's 60,000. Right, to the lifetime of the vehicle, it gives me that. Okay, okay, let me see that. 60,000. Okay, 60,000 minus 6,000. Yeah. Okay, so I get 42. 60,000 minus 24,000 plus. I get 42,000. Okay, let me do that. 24,000. No, I made a mistake. That can't be 17,000 plus 6,750. That gives me. This is wrong. 30,750 equals 2. So that's 60,000 minus 30. That gives me 29,250, right? So that's okay. So now let me explain what happened here. The 60,000, right, is how much we bought the vehicle for. 24,000 is the depreciation from the time we bought the vehicle to the 1st of March 2011, and the 6,750 is the depreciation from the 1st of March 2011 to the 1st of December. So we add those minus the value of the vehicle minus yeah. Okay, so we do that. We say 60,000 minus the depreciation. Okay, what we get the value of the car. Okay, we get the value of the car at the time it was sold, according to our book. We call that the book value. Okay, so when we get those numbers right, we get the book value. Okay, which is 60,000. Okay, minus 24,000 plus 6,730. Okay, that's the book value at the time the vehicle was sold. Okay, so it's 60,000 minus 24,000 plus 6,760. Okay, and then that gives us 29,000. Okay, 29,000, 60,000 minus 24,000 and 760. Right, that gives me yeah, that's fine, 29,000 and 750. That's right, correct. So now I need to see if I can plug in here. This is the book value. That's the value of the car according to our books. Okay, we call that the book value. Okay, according to our books, at the 1st of December 2011, the vehicle, according to our books, it's worth 29,750. So now we need to find out if we made a profit or a loss. How do we do that? So we say book value, okay, minus the price the vehicle was sold for. Okay, it will give us equals to profit or loss. Meaning, if it's positive, it's profit. If it's negative, it's a loss. Okay, that's how we know if we made value. So we know that our book value is 29. Right. So we know that yeah, we know that our book value is 29,250, right? Minus, we sold the vehicle for 30,000. So that means what? Is it a positive or a negative balance? So it's 29,000. Sorry, I think I mixed up, because obviously minus book value. Right. Yeah. So that means this is minus the book value, right? So then it's 30,000 minus 29,250, right? It gives me 750. That means we made a profit of 750. Okay, so that means we made a profit of 750. Very nice. Okay, so we are done with number 5, right? Now we go to number 4, because we could not do number 4 until we get the depreciation for the vehicle that was sold. Now we can calculate the total depreciation for all the vehicles. Okay, so let me just say total depreciation, okay, which is let's see, how much is it? You can see here vehicles, it's 401 at cost. Okay, so it's 401, right? And the vehicles that was sold, it was worth 60,000 minus the depreciation for all the cars, right? That is accumulated depreciation. It's 40,000. Minus depreciation for the sold vehicle at the time we sold it. It was, no, sorry, at the beginning of the financial year. That was 24,000. So now the total is 401 minus 60,000. Gives me 341. Okay, minus, okay, 30,000 minus 24,000 gives me 16,000. Okay, now the total is 341 gives me 325. Okay, then I times that by 25%, right? Okay, so it gives me 325. Then I times that by 25%. Okay, times 25%, it gives me 81,250. 81,250. Okay, and then to get the total, equals to 81,250. So 81,250 plus the depreciation for the sold vehicle at the end of the year, that's 6,750. Then if you add both of them, plus 6,750, okay, let's say 81,250 plus 6,750, it gives me 88,000. Okay, gives me 88,000. Okay, so I'll make this number 7. This will be number 8, just to keep it simple. Okay, what's important is you need to reference it correctly. This will be number 9. Okay, make that number 10. Then this will be number 11. Okay, this will be number 11. Okay, now all the workings are done, guys. This is the difficult stuff. Okay, if you can get this stuff going, everything from here is easy. Okay, I hope, guys, have helped you a little bit to understand this part. Okay, then we're going to do the next part. Remember, the first part is doing the workings, and referencing correctly. All those 1, 2, 3, and 4, they are very important. Okay, then the second part, which is the next part, the easy part, we're just going to take these values and plug them into the layout that you have memorized. Okay, that's pretty easy, guys. I'm so excited. Okay guys, now as you can see now, I've put here the layout for the statement of comprehensive income. Okay, now with the comprehensive income, the only thing you need to remember here is let's go back to our statement of our balances, our trial balance. Okay, so the only thing you need to remember here is if they give you a comprehensive income on the statement of on your trial balance like they did here, okay, it makes your life very easy. Okay, it's here as you can see it. Okay, so you can see here that they gave you the comprehensive income, so it makes your life super easy. The only thing you need to adjust, it's your year-end adjustments. That's the only thing you need to adjust for, because they have not been included on your trial balance. It's the parts that the bookkeeper or the accountant forgot to put into your trial balance. So you take your comprehensive income, as you can see on our layout. Okay, you take your comprehensive income, and then all you do is adjust for the additional things that you've added. Then you get a new comprehensive income. Okay, it's very easy. Okay, now let's look at our workings from what we did a little bit earlier. So the first thing we need to adjust for, as you can see here, it's the loan. Okay, because don't forget, the comprehensive income, it's income. You need to subtract out the new expenses from the income until you can get the real income that the partners have received for the year end. Okay, so the first expense, as you can see there, it's what? It's the loan. Okay, that Bafana gave to the partnership. So it's 1,000 rand. You need to. It's an expense. You need to subtract that. Okay. So now the first thing we do is the loan. We know that it's. So we need to show the workings so that the examiner knows how did you get to the 1,000 rand, right? So workings number 5. Can you see there? It's workings number 5. So you need to add in workings number 5. Okay. So we say insert number 5. Okay. Insert number 5, so we know it's an expense. It's 1,000 rand, right? Okay, second one, we come here, then we will see that the second expense is what? It's this expense account, which was not properly adjusted. We had to get the partnership had to pay for the expense, not the partners themselves. So it's workings number 6. It's 8,000. Okay, working number 6. Okay, it's an expense, so that is 8,000. Okay, and then the third thing is let's look here. The third expense is a trading expense, right? It's here. It's working number 7. That is 20,000. Okay, it's working number 6, right? Workings number 6. We need to reference it correctly, so the examiner knows how did we get to that number. It's number 7, and that is 20,000. So let me fix that. 20,000. Okay, it's working number 7. Okay, the depreciation also, it's an expense that it was not correctly accounted for. So depreciation, it's working number 8. You can see there, it's number 8. Okay, it's 88,000. Okay, that's workings number 8. Okay, it's an expense, 88,000. Right. And the last thing we need to account for, don't forget, we're looking at income and expenses. We don't look at assets and liabilities, but income and expenses. Okay, so if I may remind you, an income is what you get now within the next 12 months. An expense is what you have to pay for now within the next 12 months. Then an asset, it's what can create income for you, in the after 12 months. And liability is what you have to pay for you know, after 12 months, that's a non-current liability, and a current liability is what you have to pay for within the 12 months. But now we're dealing with income and expenses. Please make sure of that. Now, profit on sale of vehicle, that is, as you can see, it's here, workings number 11. Okay, we made profit, that's income. Okay, so we made an income of 750, that is workings number 11. Okay, I don't know the right number for that. I'll just have to improvise, so we'll make it 1. That's 11. Okay, wonderful. So what we need to do, we need to calculate the year-end adjustments, the totals. So it will be 1,000 plus 8,000 plus 20,000 plus 88,000. Okay, minus 750, that gives me 116,250 bracketed. Okay, and then the total comprehensive income before the adjustments, right? It was how much? It was for the adjustments, it was 536,500, right? 536,500, right? And then we need to take the 536,500 minus 116,250. Okay, that gives me 420,250. That's our comprehensive income for the year. Okay, so that's very easy, not that hard to do.